Hello folks, Sid Miramontes here with Miramontes Capital. Today I wanted to cover in today's webinar the biggest concerns that we found over the last 20 years that folks have. And this has been through several hundred seminars that I've hosted over the last 20 years, and of course over tens of thousands of meetings that I've held with different clients over that period of time as well. So let's cover a little bit about what your concerns are out there as far as we've been able to see. One of the first concerns that we find out there when we're discussing with folks are really, will my lifestyle change? And how do I have to go about managing myself so that my lifestyle stays as much as possible as it has been? Well, initially, if we're going to keep our lifestyle the same, obviously one way to do that is making sure that you have a very, very good handle on what your lifestyle expense really looks like. So number one concern is, okay, well, you need to have very, very good control of what's going out on a monthly basis. So the first place we start is your expenses. What expenses do we have on a monthly basis? What are those? So when was the last time you and your spouse sat together and went over those? Well, our job in retirement and as planning starts is getting you and your spouse or your partner on the same page, making sure that you both know what's really happening from one month to the next. So that may be starting from your mortgage to everything through to the cable bill, your auto insurance, your health insurance, everything that you find that you spend on a monthly basis. So, and are we going golfing when we retire? Are we going on vacations when we retire? What are you going to have more of, folks, when you retire than you've ever had before? We're going to have more time. And lots of times I hear that, as I see in magazines or I see in commercials where you see different numbers thrown out as far as what your expenses are going to be. I hear it's anywhere from, I've heard anything from 75% to 85%. In some cases, they may be 100% of your same expense that you have at retirement time. So what we want to do is we want to make sure that you know exactly what those numbers are and that you have a very good way of being able to monitor and manage those. And one way to do that is, of course, obviously by being able to note them down, but also being very realistic as far as what is going to happen when you retire. Because when you retire, folks, as I said, you're going to have a significantly more time. And with more time, of course, time is money. So you're going to have more time to spend funds. So we want to make sure that you have control of what that is and that you know exactly what you're getting into, because what you're going to do when you retire is you're going into a program that's going to last for the next 30, 35 years. So at a lot of my workshops, I ask everyone, how long do you plan to live in retirement? Well, I hear the numbers anything from 25 years to 35 years or longer. Well, your plan has to last the same amount of time. And the only way for that to happen is we have to realistically look at, this is a 30 to 35 year timeline that we have to make this work for. And you have to have that understanding that as you're putting all these figures down, that they're really realistic as to what you think you're going to spend. Okay, so that is one way you keep your lifestyle in control, and how you keep your lifestyle the same as you retire is being realistic. Also, as far as really what am I spending, I'm not that you're going to spend less, you may spend more in just about every category. So you have to be realistic to that effect, and making sure that your investments obviously are going to have to jive with what you are actually doing on the withdrawal side, on the lifestyle side. Another point that we want to cover when we look at retiring is going to be really, how do we plan to make sure that this money lasts? Well, another way that we want to make sure that money lasts is, of course, after we set up a plan. Well, obviously, the investments in your plan have to make sure that they generate the income that you're pulling out of this plan on a month-to-month basis. So let's say that you're making withdrawals of 4% a year from your program. Let's say you have $1 million, and in your $1 million, you're pulling $40,000 a year out of that plan. Well, one way that helps make sure that you do not run out of money is making sure the investments that you have are going to generate a dividend rate of 4%, so that they're able to generate that income even when the markets do not perform, even when the stock prices of those investments, of those mutual funds, of those bond funds, whatever investment you may happen to have, even if those investments were to drop in value, where the dividend rate continues to paying the same amount. So let's say that again, you invested $1 million, and that $1 million is paying you $40,000 a year in income. Well, let's say that $1 million investment were to fall and drop down to $800,000 in value. Well, as long as the dividends that you started with are still paying the same rate, well, even if the price of the investment were to go down in value, they're going to continue paying the same dividend rate out to you on a month-to-month basis. So you still continue receiving your income, and you still keep the amount. The big key here is that you keep the same amount of shares. So if you have 10,000 shares when you start, and even if those investments were to go down in value, well, now, as long as the shares aren't shrinking and you're not selling shares, well, what happens is, as the market recovers in years and time, well, what happens is you end up receiving and getting back to the upside of where you were prior. The difference happens is where I find in a lot of other folks, other financial professionals, I find that they set folks up in investments where those investments sell every single month. And when investments sell investments every single month, well, your shares start shrinking month after month after month after month after month. And like the markets have been lately in the last couple of years, have been fairly volatile. Well, when you have a lot of volatility and you're selling shares on a month-to-month basis, you could end up with significantly fewer and fewer shares. So even if your stock price were to go back up, well, you may have started with 10,000 shares at the beginning, but now, good night, folks. Now, 2 or 3 years later, well, good night, you might have only 7,500 shares left. And so even if the stock price were to go back up to where it was, well, good night. You have significantly fewer shares, so you have a significant fewer asset value, and now we are really, really stuck, and that makes it very, very difficult to do. So it's something to be aware of. Another point that I want to make, after you look at, okay, well, geez, lifestyle is one of concern of mine. Another was not running out of money. Well, along with not running out of money, one example that I give is many of you have met with other financial professionals, and I give this example of a piece of real estate. I use the example of saying that, hey, let's say that today was your retirement date, and you were receiving $1 million, and you took this $1 million and you purchased an apartment building with the monies. Okay, so you take your $1 million and you go out buy an apartment building, and all your money is all your retirement funds are tied up into that $1 million piece of property. That $1 million piece of property is going to pay you your income every single month for the rest of your life. Okay, so you write the $1 million check to your realtor or property manager, and you hand that check over, and you said, okay, well, here's my money, and as you start driving away and you're looking at in that rearview mirror and watching that property shrink in the distance, when would be the next time you'd go back and take a look at that property and monitor that property and see what's happening with it? Well, when I ask you that question in workshops, inevitably the answers are I'd be there the next day, or I would move in, or I'll check on it much more regularly than I would anything else, which is every 2 weeks or once a month to collect the rent. Well, then I ask the question, if you're going to make sure that you do not run out of money, and I call it your apartment building's on fire, would you really review that property once a year? Would you actually go back and review with your property manager, your realtor who's managing for you once a year, if it's your $1 million piece of property or real estate where all your money is coming to you on a monthly basis and everything that you have is built into that? Would you really spend 3 hours once a year with that person to review what's happening? Or you think that might be too late? Well, obviously the answer is yes, it's too late. When you retire, folks, you have to be much more proactive, because now there isn't a paycheck that you're receiving every 2 weeks that, hey, if your portfolio goes down in value, well, it doesn't matter, of course. Obviously, when you're working, you're not as worried about it because you're not living off those assets. But now we are. So we basically have a program where we call it constant communication and continuous analysis of your portfolio, where we're reviewing your portfolio every 30 to 45 days for the rest of your life. So we know what's happening with the markets and how that relates to your account. And also, we're in tune with what's happening with you. because we know, hey, here's what's going on with Mr. and Mrs. Jones. This is what they're doing that's going to affect this portfolio. So that way we can match both up together. Because if we meet with you once a year, folks, 365 days from now, how do we really know what's happening? How can we really connect the two? You have a real big disconnect. Well, and obviously, if you own the apartment building, you're going to check on it much more regularly. Well, guess what? If your livelihood depends on it, we need to check on this much more regularly as well. So that has to make sure that both pieces work together. So that's why we're so in tune and communicate with you as often as we do, because we're going to check in with you folks somewhere between 10 to 12 times the first year and the next year and so on, where someone else might talk to you 10 times in a 10-year period of time, okay? In 10 years, we may talk to you 100 to 120 times versus someone else may check in with you 10 times. Who will know you that much better? Who is going to be able to perform because they know what's happening with your portfolio? And let me give you one other simple example. Let's say that you're buying a new vehicle. And let's say that somewhere, 3 months from now, you tell us, hey, Sid, I may be buying a new vehicle in the next 3-month period of time. And let's say that vehicle's $20,000, for example. Let's say that we're doing a check-in call with you. And we find that, hey, you know what? Mr. and Mrs. Jones, they're buying a new vehicle in the next 90-day period of time, but the market is at a high right now. Well, we might want to sell the investments now and put them in cash for you, or just direct deposit into your bank account so it's ready to go when you need it, instead of you calling me when the market is significantly lower, and you call me a few days before you need the monies, and we have to sell significantly more shares to give you your income. That's just one simple way of, by us being proactive, we're able to stay on top of what's happening out there to you, okay? So hence the reason for the continuous communication, constant analysis that's needed to be done for your portfolio. Other thoughts, folks. When we're looking at, Social Security, when we're looking at the additional planning, other questions arise, that become, when do I take Social Security, which is another point that we need to be aware of. When do we take Social Security? And depending on who you are and how your financial situation stands, that will really help us decide whether Social Security is better for you at 62 or 65 or 66, depending. Okay, folks? So I don't have a hard and fast rule as far as when you should withdraw Social Security. It will really depend on what your financial picture looks like. So let me give you an example. Let's say that you are retiring, and let's say we look at your numbers, your expenses, and we see that you used to, with your lifestyle, you need a $4,000 a month income. So let's say that your retirement plan generates you a $3,000 a month income, and let's say you're at 62 years of age when you retire, and you're going to start with, at 62 you're able to withdraw $1,600 a month after taxes. So between both programs, you're able to generate $4,100 a month in income. And let's say that, but your accountant is only able to generate that $2,500 a month income. And let's say that if you were to wait a few years longer, you would receive another $400 more a month by waiting a 4-year period of time. Well, in some cases, it may be more beneficial for us to withdraw Social Security at an earlier age, because what happens is your portfolio may not be able to stand to have you take the whole $4,000 plus a month out of your plan on a monthly basis and wait another 48 months for Social Security. So it may be more beneficial for you to start withdrawing Social Security at 62. Another example would also be that it's what we call the time value of money. Lots of times for many of you, what I've found over my last 20 years of retiring over 2,000 folks from major firms throughout Southern California and business owners throughout Southern California, is that from 62 to about your late 70s, that's when the majority of your expenses are made. So when you're younger, because because you're more active, you're going to spend more money on the front end of retirement. And as you get older, obviously, from activity slows down, and so expenses start trailing off. So normally for the first 16, 17 years, we see expenses rise, and then we see them start slowing down as one were to get older. So if you withdraw Social Security earlier, in lots of cases, it may be more beneficial for you to withdraw Social Security because this is when your capital expense really picks up and is really expanded, and where it may not benefit you as much to withdraw later. Let's say though, if you're in great financial shape, and let's say that you're spending $4,000 a month in expenses, and you know what, your retirement account generates $5,500 a month in income. Well, in this case, waiting till you're 66 years of age may be an easy fix for you. Okay, so in this case, maybe it's a simple decision to make, and it's easily done to wait. But in other cases, it may not be more beneficial. It may be more beneficial for us to withdraw Social Security sooner because your break-even point in many cases will not be for several years. Another example that I'll give you is, let's say you're 62 when you retire, and you decided to start withdrawing Social Security. And you might say, well, what's my break-even? When do I break even on Social Security if I were to wait to 66 versus 62? Well, in lots of cases, I've found that the average age is somewhere between 78 to 80 years of age. So if you were to wait until 66, in many cases, you have to be 78 before you start breaking even on all the money you would have withdrawn from 62 to 66. So in some cases, that might not be worth it for you because, hey, your capital expenses may be increasing on the front end. And of course, your expenses start sliding off at the back end. So, hey, you know what? You may not be as concerned about having additional money and there being a big profit margin late in your life. So we have to take a look at those numbers and see, hey, is it more beneficial for you to withdraw Social Security earlier? Or, hey, is it more beneficial for you to withdraw Social Security later? Also, too, spouses can also draw percentages of half of other spouses' Social Security. As long as they're 60 years of age, when one is 62, one spouse can draw half of another spouse's Social Security. So those may be other benefits where, hey, you know what, your retirement account may only generate $2,500 a month and we're spending $4,000 a month. Well, we may start drawing Social Security at 62 for one of you, and then also have the other spouse take half of your Social Security. So let's say you're receiving, again, $1,600 a month. Your other spouse may be able to withdraw another $800 a month, so you may receive $2,500 plus your Social Security of $1,600, so that's $4,100, and then you were to receive another $800 a month, so that's $4,900 a month. So now you're receiving that $4,900 a month between yourself and your spouse, and you may only have expenses of $4,000 a month. Well, now we can do it. Now it'll work. So Social Security will depend on your particular situation, and we'll build the program depending on what works best for you. Another concern that folks have is debt. What happens with my debt? How do I manage it? I can't retire because I owe too much money. Well, that may and may not be true, folks. We really have to take a look at that. But let me give you an example of cases where we found that we were able to manage it. Okay, so let's say that I had a person that recently retired with us, and like I said, we've retired thousands of folks. So recently had a client that had a significant amount of debt on credit cards. It was $40,000 plus in credit cards, and this person was paying $2,500 a month in credit cards on a monthly basis. And so we looked at the program and looked at the expenses. The numbers didn't look too great because there was so much on credit card debt that we had to pay on a monthly basis. And so let's say that the expenses were $2,500 a month in normal expenses with the house note and car and electricity and all those other things that you have on a monthly basis. And then we had this number, $2,500. So $2,500 is what regular life cost, and then there's another $2,500 a month in expenses up to credit card payments, which tallied up to $5,000 a month in expenses, and there was into the $45,000 worth of credit card debt. Well, in some cases, folks, this person was 59 and a half, already over the penalty-free age, but in some cases, it may be more beneficial for us to trade your dollars for debt. okay? So let's say that her retirement account, this person's retirement account generated $3,000 a month in income. And we have $5,000 a month in debt or expense on a monthly basis. How can we make that work? Well, in some cases, it may be beneficial for us to take your capital and make a one-time withdrawal from your retirement plans and pay that debt off, because this way, this gives you cash flow. So now we're able to take that $45,000, eliminate $2,500 worth of debt. Now we've got $2,500 in expenses, folks, versus your $3,000 a month in income. In this person's case, they also had Social Security, so that was an additional income on top of that. Now that person was able to live comfortably, but they were very, very concerned about the fact that they couldn't breathe. They could barely make it as they were going right now between the husband and wife. Well, those are things where it may be more beneficial for us to take a one-time withdrawal, talk to your CPA, and make sure, hey, is it better for us to retire at the end of the year, so we make this withdrawal on January 1st of next year, so it's on next year's taxes? Or, in talking to your CPA, is it better that we break it up and we take $22,500 in December of this year and take $22,500 in January of next year, so we break it up into 2 tax years? So it'll really depend on, but we have CPAs on our team as well that can give us advice and give you advice. Or we can talk to your particular CPA or tax person to make sure that we're all on the same page. But all the way through, folks, we have to make sure that we're all dialed in, that we understand exactly what's happening with you. And there are many, many, many folks. There's more than one way to skin a cat, as they say, as the old saying goes. I mean, there's many, many things we can do, folks. You have to be open to all the options that are available, that are out there. And there's many, many options that are out there. We've seen them all. So looking at things, those would be some of the few examples that I would share with you. Finally, I'd like to say is, a lot of folks are always concerned about inflation. I hear the word over and over and over again. Inflation is a standard figure that's the cost of products going up year by year by year by year by year. And I'll say that for me, inflation is really 2 different things. Inflation goes back to the very first point that we started with, is inflation really has to do with your lifestyle, folks. So if you spend all your time at Nordstrom's, then you're going to have a Nordstrom's cost of living. If you spend your time at other places, well, then you'll have that cost of living. If you go to Target, that's one thing. If you go to Black Angus, it's one thing. But if you go to Mastro's steak, it's another. So it'll really depend on lifestyle. Has more to do with your portfolio and your assets having a successful retirement than any other factor that I've seen. The markets will do what the markets do, but you have more impact on your monies than any other single factor out there that I've seen. I'll say this as well. The other part of inflation that I see, to me, is, folks, okay, you're worried about prices of goods going up. Who's raising the price of the goods? Well, the store is. Okay, so Target's raising the prices of goods, or Chevron's raising the price of gas, or Microsoft might be raising the cost of their software, or Apple may be raising the price of their iPhone. Well, the only way that you're going to be able to stay right in conjunction with what's happening with the inflation rates is that you have to be on both sides of the cash register, I call it. And what I mean by that is you're on this side of the cash register, you're buying those goods, you're paying the price. You're pulling your credit card out or writing a check on different goods and services. Well, folks, if you really want to make money, you have to be on the other side of the cash register. I need to be on your side, or you need to be on my side. We need to basically, so if the prices of gas are going up, well, we need to get on this side of the cash register. We need to buy the stock in those things that are raising the prices for you, because that's the only way you're going to have balance. You cannot be on one side of the cash register to be able to benefit. I mean, hey, you know what? If all it is your assets are going out, well, inflation is going to eat into you, folks. We have to make sure that you're putting money on both sides. So you're able to take advantage of, okay, well, I own the stock, or I own Microsoft stocks and software is going up. Well, I'm going to basically be able to balance this out. Or Apple computer stocks doing fantastically well. Well, geez, I just spent another $600 for another contract with Verizon for a long-term contract. Well, you need to buy those stocks that are able to balance your portfolio out and balance your cash register up so that you're both sides of the equation. Folks, in school, right, they used to say, hey, you have to, whatever you do on one side of the equation, you have to do the other side of the equation. Well, we have to do the same thing too, folks. Inflation will definitely get you if you don't have both these pieces in line. So those are the concerns that I find that clients have on the inflation side, where, hey, lifestyle is big key, but so is being able to, you have to invest in stock investments if you're going to take advantage of what's happening to those things that are raising the prices for you and to you. Okay, folks, so those are my points. I will tell you that please continue to view our YouTube channel and take a look at what is available and on there. Also go to our website because we have many, many things on there that are resources for you that will answer many, many questions. And if you have any questions or concerns, please send us an email or give us a call. We look forward to seeing you soon. Thanks for your time.